With every trade, buyers and sellers bring new information to the market, which helps set prices. No one knows what the next bit of new information will be. The future is uncertain, but prices will certainly adjust accordingly. This doesn't mean that a price is always right. There's no way to prove that. But investors can accept the market price as the best estimate of actual value. If you don't believe that market prices are good estimates, if you believe that the market has it wrong, you are pitting your beliefs and hunches against the collective knowledge of all market participants. Many fund managers believe they can identify mispriced securities and convert that knowledge into higher returns. But fair market pricing works against such efforts, as indicated by the large proportion of mutual funds that have underperformed their Morningstar category index. In this chart, the gray bars represent the number of U.S. domiciled equity and fixed income funds in operation over the past 15 years. These funds compose the beginning universe of that period. The dark gray areas show the percentage of equity and fixed income funds that have survived the 15-year period. The blue and green bars show the smaller percentage of equity and fixed income funds that survived and outperformed their respective Morningstar category index over the 15-year period. Our research shows that over both short and long time horizons, the deck is stacked against mutual funds that attempt to outguess the market. Some investors may resort to using track records as a guide to selecting funds, reasoning that a manager's past success is likely to continue in the future. Does this assumption pay off? Does it even make sense? The research offers strong evidence to the contrary. This exhibit shows that among equity funds, stock funds, ranked in the top 25% based on previous 3-year returns, a minority also ranked in the top quartile of returns in the following 3-year period. A lack of persistence casts further doubt on the ability of managers to consistently gain an informational advantage on the market. Some fund managers might be better than others, but track records alone may not provide enough insight to identify management skill. Stock and bond returns contain a lot of noise, and impressive track records may result from good luck. The assumption that strong past performance will continue often proves faulty, leaving many investors disappointed. Most people look to the financial markets as their main investment avenue, and the good news is that the capital markets have rewarded long-term investors. The markets represent capitalism at work in the economy, and historically, free markets have provided a long-term return that has offset inflation, and even better than that. This is documented in the growth of wealth graph, which shows monthly performance of various indices and inflation since 1926. These indices represent different areas of the U.S. financial markets, such as stocks and bonds. The data illustrates the beneficial role of stocks in creating real wealth over time. T-bills have barely covered inflation, while longer-term bonds have provided higher returns over inflation. U.S. stock returns have far exceeded inflation and significantly outperformed bonds. $1 invested in small-cap stocks in 1926 would be worth considerably more today than $1 invested in large-cap stocks. The size premium. Keep in mind that there's risk and uncertainty in the markets. Historical results may not be repeated in the future. Nevertheless, the market is constantly pricing securities to reflect a positive expected return going forward. Otherwise, people would not invest their capital. It's important to realize that markets go up over long periods of time because human capital and human ideas create a higher standard of living. This is not a casino. Creating value through increased standard of living is why we all need to be long-term investors. Rather than viewing the market universe in terms of individual stocks and bonds, investors should define the market along the dimensions of expected return to identify broader areas or groups that have similar relevant characteristics. This approach relies on academic research and internal testing to identify these dimensions, which point to differences in expected returns. In the equity market, with stocks, the dimensions are size, small cap versus large cap, relative price, value versus growth, and profitability. In the fixed income market, these dimensions are term and credit quality. The return differences between stocks and bonds can be considerably large, as can the return differences among a group of stocks or bonds. To be considered a dimension, it must be sensible, backed by data over time and across markets, and cost-effective enough to capture in diversified portfolios. In a dimensions-based approach, capturing returns does not involve predicting which stocks, bonds, or market areas are going to outperform in the future. Rather, the goal is to hold well-diversified portfolios that emphasize dimensions of higher expected returns, control costs, and have low turnover. Many people concentrate their investments in their home stock market. They might consider their portfolio diversified when they choose a large group of U.S. stocks or U.S. mutual funds. In some cases, investors may hold only a small group of U.S. securities, or even a single U.S. security. Yet, from a global perspective, limiting one's investment universe to a handful of stocks, or even a single stock, no matter how big that company, is a concentrated strategy with possible risk and return implications that could devastate an investor. This slide offers a conceptual comparison of investing only in the U.S. market as represented by the S&P 500 index, and structuring a globally diversified portfolio that holds assets in markets around the world, as represented by the MSCI All Country World Index. For the global portfolio, holding thousands of stocks across the world's developed and emerging market countries broadens one's investment universe. A diversified portfolio should be structured to hold multiple asset classes that represent different market areas across the world. That is how we can best capture the returns of markets and soften the overall standard deviation of portfolios. Even with a globally diversified portfolio, market movements can tempt investors to switch asset classes based on predictions of future performance, or even just to believe that they can hop in and hop out of the market, or to pick a winner. This slide features annual ranked performance of major asset classes in the U.S. and international markets over the past 15 years. The asset classes are represented by corresponding market indices. The patchwork dispersion of colors shows that the relative performance of asset classes is unpredictable across periods. Investors who follow a structured, diversified approach are well positioned to seek returns whenever and wherever they occur. Diversification also reduces the risk of being heavily invested in an underperforming asset group in any given year. The 2008-2009 global market downturn offers an example of how the cycle of fear and greed can drive an investor's reactive decisions. Some investors fled the market in early 2009, just before the rebound began. They locked in their losses and then experienced the stress of watching the markets climb. Staying disciplined through rising and falling markets can pose a challenge, but it is crucial for long-term success. News and financial commentary can influence people's view of investing. Without a strong investment philosophy to guide them, they also may follow the advice of friends, neighbors, or family, especially if the insight promises a fast, easy return. But growing wealth has no shortcuts. Success requires a solid investment approach, a long-term perspective, and discipline to stay the course. To have a better investment experience, people should focus on the things they can control. It starts with an advisor creating an investment plan based on market principles, informed by financial science, and tailored to a client's specific needs and goals. Along the way, an advisor can help clients focus on actions that add investment value, such as managing expenses and portfolio turnover, while maintaining broad diversification. Equally important, an advisor can provide knowledge and encouragement to help investors stay disciplined through various market conditions.